Hello guys, welcome back to another trading video. In this one we're going to be analyzing Tesla ticker TSLA. Now we did cover this one, especially in the Discord, again free to join in the description. Just kind of covering the short buys we had on it, and again where we wanted to get short and the targets we would trade to. So that is basically covering here because we pushed up to our third deviations. And again, this is how we do our analysis, especially our technical analysis, is off these standard deviations. So again, we were able to catch this short all the way down just by following these standard deviations. And so again, this is what we're going to cover now. Right now we're definitely sitting in an area I wouldn't want to trade as much, kind of around this 215. Again, you can see we're kind of by these golden lines. What these golden lines are: the dashed line is a 6-month level, the solid line is a 1-year level. The golden lines signify the first standard deviation. So first standard deviation, that means 68% of the data should trade below it. But again, that doesn't give us a great win rate if we're looking at something like that. So we instead want to see price break up. And again, I wouldn't trade this area at all. I wouldn't trade to the upside. I wouldn't trade to the downside. That's a lot harder to predict. However, if we start getting pushes to the upside, this is where we can start looking to retrade. And again, this would be coming into kind of the 250 to 256 area, because again, this is then coming into our second deviation area, and this can create some high probability shorts. And again, the way I would use this as well is not only then do we have our key level, but we start needing to see how we react, especially on something like the MACD or the RSI, and just start seeing, do we provide divergences on this move? If so, that can be a really nice trading kind of confluence and add to our confidence on the short. Now, this is definitely a shortable level. Again, it would be more as a kind of short-term trading level to me. I would look for the quick pullback and then kind of get in and out. However, if we can make one higher push, then around 280 to 285, this is where we come into our strong short bias levels. This is our third deviation. 99.7% of the data should trade below that level. Again, obviously, nothing trading is going to be that accurate, but it is just a good signal that if we start pushing up to this price, we can expect some shorts, a bit like how we basically had it here. We came back down to fair value, which again, from entry down to target, provided a 27% decline in stock price. So again, basically the same setup. If we come back up to kind of this 285, 280 level, we can look for these same shorts and again back down to fair value, which is these white charts. That is statistical mean. So that would be the nice shorting opportunity and what I would watch if it comes to the upside. If we did go a bit more parabolic, that's around 315. That would be kind of those next kind of key short bias areas. The only time you ever kind of get scared and kind of jump out of these shorts is if we kind of break above this fourth deviation, we come back, we test it as a support and we hold. If we kind of do that, then really this is showing that the stock will go parabolic, which again is something Tesla can do. We've seen it happen time and time again, so it's definitely something if you are kind of short bias on it, know when to kind of cover. And again, normally I'll trade it with puts, so you can kind of just risk what's in the options, but especially if you're trading shares, do be careful if we ever hold a fourth deviation bounce. Now, to quickly cover the downside move, then again, we're kind of still sitting between the +1 first standard deviation and fair value. So again, still no trading opportunity really right now. If we start to sell off again, we're coming into around 170 to 150 is our first deviation. So these can provide a quick temporary bounce, but again, nothing I'd really put too much size in or too much risk in. However, if we start breaking down between 118 and 140, again, use these as individual levels just because they're so far apart. But between those levels, again, these can be nice long bias opportunities to be looking at. And if we break even lower, 110, and in this case 85, again would be our third deviations. And basically these are the exact same setups as we get up here. And basically like this setup, if we come down to here, these are going to be high probability long, so something we'd look to take. Again, even just with the calls, risk what you put into the trade. You don't then need to run like a hard stop. You just risk what you're willing to lose in the call options. And again, we then look for that bounce. Your main target can be fair value, but again, obviously we're going to take profits at these deviations along the way, because again, these are always areas where we could potentially then continue that downtrend here. That's what it is. So again, basically the main way I would use these is if you're using the first and second deviations, you use these more for quick scalps and bounce plays, maybe as a day trade and potentially a short swing. Third deviations is where we can actually kind of look for the whole overall trend reversal back down to fair value and can provide us those high kind of risk to reward trades. So that is kind of the breakdown on Tesla. Again, right now I would be more patient in summary, and either way kind of push up to kind of 250, ideally the 285s if we're looking at shorts. And for longs, again, we can get some scalp longs kind of around 140, 118, but really again the nice reversal play is going to be 110 to $85, and again these are the ones that we can actually hold for those longer term moves. Again, you can always trade to the deviations. That's personally not how I like to trade. I like to just trade once we get there, so not going to be something I touch until we kind of make that significant move down to one of those two levels.